M&A is a process and not an event.
Welcome to Price Discovery, Money and Mindset. Go under the hood with Jordan Rodriguez, a certified financial planning professional and certified exit planning advisor, as he explores the art of balancing wealth with personal fulfillment. We'll hear strategies and stories from industry experts, business owners, and thought leaders about navigating the complexities of high net worth families and businesses. Without further ado, here's Jordan Rodriguez.
Hello, friends, and thanks for joining. I had the privilege of sitting down with Scott Mashuda, founding partner of River's Edge Alliance Group, a lower middle market M&A firm located right here in Cleveland, Ohio. Scott's also chair of the M&A Source and an active member of the Cleveland chapter of the Association for Corporate Growth. Scott's a deal maker through and through, and you'll enjoy listening to some of the stories and experiences that he's had in the industry over the past 20 plus years. I really enjoyed this conversation, however, because he double clicks on how important it is to structure a deal, not just based on the highest possible multiple or bottom line number, but in a way that aligns with an owner's desired outcome. Here we've got Scott Mashuda from River's Edge Alliance Group on the podcast. Welcome, Scott. I appreciate you taking the time. I think this will be a fun conversation because you are the man with the plan in 2024, which I think is a year with a lot of, dare I say, uncertainty, probably the most overused word over the past few years. But in lower middle markets, I don't know if we know what to expect. We had 2020, which just threw a wrench in everything. It seemed like 2021 and 2022 were years where we were focused on interest rates and inflation, but business stayed relatively good. And 2023, just the disparity between how people were feeling and public equity markets leave us with a big question mark in 2024. But before we get to all of that, I want to focus on you as an individual and a little bit about your story. 20 years ago, way back in 2004, you left EY, Ernst & Young, and set up your own shop, as I mentioned, River's Edge Alliance Group. I'd love for you to take me through that decision and how you think being a business owner allows you to better relate to your clientele.
Yeah, great question. So I was about 26 years old 20 years ago when I decided that this was a bright idea. And, really the thought process, I was in the business valuation group there. And so, we valued businesses. I wasn't really doing much M&A as part of that group and really just was looking for a business to buy. To be honest with you, I wanted to be an entrepreneur, wanted to be my own boss, like, a lot of people, I think. But understanding valuation and how to value a company and looking what was out there available for sale that I could afford, there was a disconnect, between what the asking price was on those businesses and what I thought they were worth. And so really came up with this idea of why don't I marry these two concepts? Say, okay, I can be my own boss and I can, go out there and help small business owners transition ownership through my valuation knowledge. And so I really left E&Y, went into business brokerage. Technically, we're now lower middle market M&A. We've pivoted since we've started. That business brokerage idea for us, was a terrible idea. It sounded great in theory, but at some level, folks just want to own a restaurant, right? They just want to cut hair. They don't care about your discounted cash flow model. And my argument always was, well, hey, that's great that you want to do this, but if you can't make money doing it, why? Why are you doing this? And there's a difference between salary and money that you have coming in from the job you're performing and value that's being added to the business through excess cash flow that's attributable to the business itself, right? So a lot of these very small micro companies are really just jobs for people, and there wasn't a lot of value that we could add in that segment. So understanding what we did about valuation and kind of where we fit in the world, we moved the business into that, upstream, if you will, in terms of size, where the businesses that we're dealing with are not necessarily Main Street, meaning, restaurants, retail, things like that, but we're dealing with lower middle market manufacturing, distribution, B2B service, something that is saleable and marketable to a strategic acquirer or a private equity firm, financial acquirer, family office, a little different than an individual type of buyer. So that was quite a journey figuring all that out. I figured it out the hard way by, learning, doing, and failing. And I think, failure is really just such a great lesson. If you really want me to take this podcast sideways for you, We don't let people fail enough today, right? Where everybody's afraid to fail, afraid to let their kids fail. And I think that's a big, giant mistake because, the way that you learn is really through failure. And it's the same way that we did it. And we're really good at it now, right? Because we've stumbled through it. We've seen the flaws that people have had over the course of time in terms of trying to do this. And I just think that's how you get to today.
Sure. It's only a failure if you don't learn from it. That's what they say.
That's exactly
anyway,
right. Yeah. Well said. Well said.
So I guess that's 20 years ago. You've got a ton of industry knowledge over the past 2 decades. And I know that you have other members on the team that have diverse knowledge as well. This is going to be a loaded question, and I hope that you take it in any direction you see fit. But over the course of the past 20 years, what are some of the most dynamic changes that you've seen in the market that you serve?
So that's a tough one. We've been through a lot in 20 years. 08, 09 happened. I think I could have been dead and made more money in 08, 09 than we really did. COVID happened. So a couple big market adjustments. And, for me, you just learn so much in that time frame. I always tell people that I'm kind of an old man now in how I think. You come out of business school and you think, okay, well, if I can make 10% and I can borrow at 6%, I can make 4% all day, right? And so you borrow, you just do it and take your 4%. That's all great as long as your cash flow is coming in, right? Or it's going up. As soon as it falls off the cliff, now you're servicing debt that you don't have cash flow to cover, right? And so I think, personally, that's one of the biggest changes I've made in terms of how I think about the world, how I think about investments, how I think about buying businesses, right? And I think you're seeing that now coming out of COVID. Folks got a lot more conservative in terms of how they're viewing the investments of these small to lower middle market type businesses, right? We're looking at things now that we didn't always look at, right? We didn't always look at industry concentration. And we always looked at customer concentration, but we never thought an entire industry would shut down. And that happened. You're looking at, okay, well, we're not just going to pile, the whole LBO model, right? Of piling as much debt on there as possible because that is cheaper. It's okay. We need to have room for a hiccup. The folks that are in positions of influence today have seen hiccups. Everybody might not have been in the 08, 09 scenario. That was, a while ago now, but everybody was through COVID for the most part. And I think that really changes your thought process. It changes your appetite for risk. I think by everybody's nature being an investor or a business owner, you have a pretty good appetite for risk. But there's a difference between, taking some risk and being stupid. Those are two different things, And so I think you're seeing that play out today where, if you look at the industries that we serve, for example, there is certainly a race for quality in the businesses that are out there, and available for acquisition. The good ones are moving at premium multiples, and the ones that, aren't as of higher quality, they're a little bit difficult to move.
Understood. Yeah. Do you think anything that you're seeing out there right now is fleeting as opposed to permanent? And I guess I'll give you an example. If we look over the past few years, you hit the nail on the head with the debt question. It really wasn't a function of, hey, we need to find a quality company. It was a function of, I can borrow money for free, so I'll buy anything because the hurdle is nothing. Do you think that was the anomaly in what we're living through right now with still historically, dare I say, normal interest rates, people upping the quality that they're looking for? Like, which one is permanent and which one is fleeting?
Yeah, I think the era of free money is pretty much over, right? We're not going to see that again, in my opinion. There's still a lot of capital out there that needs put to work. It's not expensive capital, right? When you think about it. And again, this is all relative. Everything is relative. So if you think about, when my parents built their home in, 1981, interest rates were what, like 17, 18%, right? And, we were at, what, like 2.5% for a while, 4%, right? That's a crazy spread. Do I think we're going to 18? No, right? But I think where we're at now is pretty much where we're going to be for a while. I don't see us going back to, the era of free money with all the money that was pumped into the system. That's done. It's over with. The math, obviously, it changes the math a little bit for folks. But at the end of the day, what I do is really driven by supply and demand. And that's the fundamental rule that a lot of people seem to forget or just glance over, right? Is yes, the math has to work. But before we get to math, it's like, okay, markets are driven primarily by supply and demand. And which side of the equation, are we leaning? Are we tilted towards, right? And there's so much capital out there that needs put to work that it's like, hey, is it a buyer's market? Is it a seller's market? It's a seller's market, right? If you have a quality company, there are a lot of folks out there with capital that are looking for a place to invest and to make, outsized returns, right? Well, lower middle market type businesses are the place to do that. And I think that, that's the fundamentals, done and done.
Yeah. Now, I mean, you're doing my job for me because it's a great transition into, I guess, the micro here. The Exit Planning Institute publishes annual studies where now this year they actually did a national survey. In previous years, they normally highlight a specific state, but in all of those surveys, the average of successful business transitions usually hovers around 30%, meaning 70% of small businesses don't successfully transition, whether that's an internal transition to the next generation, an external sale to a third party. Thoughts on that percentage, if that aligns with what you see as boots on the ground, at least here in the Northeast Ohio market? And if so, what are some of the factors behind why there is such a low success rate?
How long you have here? So that statistic alone is a little bit deceiving, I think I would say, right? Because when you say small business, well, what defines small business, right? So it's covering what's probably a very large segment of the market, and I think if you go back to the discussion that we started with, there is a very distinct difference between, selling something that is a local market, a Main Street type business that's attractive to an individual buyer within a certain geography only of that business, right? Meaning, let's say it's a hair salon, right? It's only going to pull clientele from a certain radius. It's only going to pull a buyer from a certain radius, right? And oh, by the way, that buyer is probably an individual, so they have to have the capital to acquire it. All right, well, now they have to have the capital to acquire it. Oh, and of all the things they could invest in and buy, they want to buy a hair salon. Chances are they know how to cut hair, right? So they have to have the capital, right? They're a hairstylist that has to have the capital, and I always equate it to when you're looking at a buyer for something like this, go to a football game, go to a baseball game, and say, hey, how many people want to buy a business? Oh, a whole bunch of people are standing up, right? How many people have the capital to do it? A whole bunch of people sit down, right? How many people want it to be a hair salon? Oh, a whole bunch more people sit down. Okay, how many people? How wants to be a hair salon in this particular location? Well, now a whole bunch more. Is anybody going to be left standing at the end of this? Right. So that's very different than saying, hey, I have a company that does, printed circuit board assembly. They do 30 million in revenue. They do, $4.5 million of EBITDA. That is attractive to a strategic acquirer. That is attractive to a private equity acquirer. There's a lot of different questions there. It's not a local market. It's not a local buyer. If you sell one of those businesses, right? Say you sell a printed circuit board assembly company and the hair salon doesn't sell, well, 50% of the businesses in the study now sold, right? But You're looking at two very different animals, right? And that's where I say, okay, well, across the board, do I believe the statistics? Absolutely, right? Because look at how many micro and small businesses are out there where the business owner built it around themselves because they had a skill or a trade or something that they really wanted to do, electrical work or plumbing, or like I used the hair salon example, and that business is built around that owner and their skill set. And when that person looks to retire or looks to transition that business, if they didn't build infrastructure around themselves, they didn't build a company, right? Then they just built a job, right? They might be doing very, very well, but it's still essentially just a job. And so I think that's what's bogging down those statistics, is the number of those companies, the volume of those companies is much greater than the ones that are, I'll call it upstream a little bit, that have that infrastructure built, that are attractive to those other types of buyers, essentially. So it's really tough to kind of put a pin in this for that reason.
Sure. No, and it's an important distinction. I think a lot of times, I mean, you and I both operate in lower middle market, which I define as 10 to 50 million, or you could do 5 to 50 million in annual recurring revenue. And people sometimes say, well, who's helping the little guy? It's not a function of us not wanting to help a certain segment of people because they don't do enough in revenue. It's literally a different paradigm. I mean, there's not much to do as far as decentralizing the business owner in those sub $5 million. And $5 million is just an arbitrary number here, but you can't decentralize the business owner when it's a one-person business. So I'm glad that you hit that, because I've always heard that statistic and thought there's got to be more that goes into this. If we double click on what you do specifically for your clientele, you're taking people through, it could be buy side, could be sell side, but M&A in general. What is one of the most common misconceptions that you think business owners have about M&A that you'd like to demystify?
Good one. I would probably say, M&A is a process and not an event, right? Folks think about it as an event. One day I'm going to have this exit, like it's an event. Well, listen, it takes, call it 12 months, right? 9 months or 12 months. You don't just come to somebody like myself and then you're out of this thing in the next 2 months or something like that, right? We've got to collect a whole bunch of information. We've got to put the information together in a way that buyers and investors want to see. We have decks that we have to build. There is no active market, like if we use real estate as an example, there's no MLS, right? Where businesses are sold, where you just post this thing out there and then boom, buyers start coming to you. The market is very specific for that individual asset or that individual business. Who we think we can extract the most value from. We're very thoughtful about that. We're putting lists of those companies together. We're approaching those companies. We're getting non-disclosure signed. We're getting feedback, from those potential acquirers. We're answering a ton of questions, providing a ton of information that we've already prepared. We're getting LOIs in. We're sifting through those. We're negotiating those. We're touring the business. We're having management interviews. Then we're signing up with a group, right, to go exclusive with them on an LOI. And then they're doing their due diligence. We've got to put the financing together and assist them in doing that. And then we've got to close the transaction. I mean, that's a 9 to 12 month process, And so I think folks tend to get fatigued, or they hit that point and they say, okay, I'm ready to go. And it's really disheartening when you come talk to somebody like myself. You're like, okay, well, we'll get you out in about 9 to 12 months. Let's get started now, right? And a year from now, you've got to say, wait a minute, I'm ready to go. Yeah, okay, but this is what it takes, right? This is what's involved in that. And I think folks don't really understand that at the beginning. And so, when I hear folks give me a timeline where they, and think about it this way too, a buyer's probably going to want you to stay around for a year,
Exactly.
right? At least maybe 2 years after the fact, right? So now we're looking at 3 years, and you didn't plan for that. You weren't thinking, hey, listen, I'm starting to wear down. A few years from now, I want to get out of this. I should start thinking about the M&A process now so that I can actually be out and, be on the boat in 3 years, right? Versus, hey, I'm feeling it now, I'm looking at it down the road and I just get disenchanted, by what I'm being told. And what happens is, and I'm sure you realize this, is like, hey, if you tie yourself too much up in this process, which is why you outsource to somebody like us, then the business starts to decline, right? It's a full-time job to run an M&A process. It's very, very involved, so the business owner has to stay focused on the business. And so, my point in saying all this is, hey, if you're getting distracted by this process, it's wearing on you mentally, you're not focusing on the business is affected as a result. I mean, the whole thing just starts to snowball, in terms of what you spent your whole career building. So being thoughtful about the when, getting started earlier, planning, being real about the conversation and what all's involved. I think the Exit Planning Institute's doing a great job of educating the market, and a lot of the wealth management advisors that are working through this are doing a great job of educating their clients. I can see it. I can see it in the preparation that's done, and it makes all the difference in the world. It really does.
Sure. That's great to hear. And I'm having Scott Snyder, the president of the Exit Planning Institute, on next month. And one of the questions I plan on asking him is, hey, have you ever considered changing the name of the process from exit planning to something else? Because you're absolutely right. When you described it as a process, not a transaction or a moment in time, is part of the holdup that we keep calling it exit planning when in reality, somebody might not be ready to quote unquote exit, but that process starts many, many years earlier in a lot of cases. So you did a great job of highlighting that. And I think a lot of people know that in their heart of hearts, but don't necessarily, like, you don't lift up the rock to see all the spiders underneath. You generally leave that to when you have to do it.
No, and I think that's a very astute comment. I mean, I agree with you 100% in what you just said. And I think it's the fact that, people feel mortal, right? When you start talking about the exit, now you're talking about your own mortality. I mean, you're not the young guy that's a young person that's out there building and growing and grinding, right? You're admitting that, hey, I'm seeing the world differently now. And I think at the end of the day, I mean, I'll just tell you about a mistake that I made when I first started the business that was very eye-opening for me. We did a seminar, an in-person seminar back in the day for business owners that were thinking about an exit. And we had name tents in front of them and a name tag. And a couple people came up to us at the break and they were irritated that there was name tents and name tags. And we looked at them like, well, what do you mean? Well, I don't want anybody to know that I'm thinking about this, right? This is confidential. Like if people find out, and I understand the confidential nature of it all, but I never extended it to an educational workshop about the topic and the fact that folks would be potentially that sensitive about someone knowing that they were there. And so that really reframed my thinking very early on to understand kind of the mindset of the business owner that's going through this. And so I agree with you 100%. I think when I always tell people, think about it as value maximization, right? How are we going to maximize the value of the business so that when the time is right, we can extract the maximum value for you? Because in all likelihood, it's the biggest asset that you own. Right? On your personal balance sheet, the largest thing on there is probably the business. So if it comes time to convert that thing into cash, which is essentially what I do for a living, right? How are we going to make sure that we're going to get the highest amount of cash on your balance sheet post-close, right?
So if the process starts, let's just call it a few years before the transaction actually takes place, who are some of the people that should be on the team of the business owner that's helping them over the course of that few years leading up to the transaction?
Yeah, great question. I mean, the first one to me is on the wealth management side, right? Understanding, because there's a couple pieces and parts here. One, what's the after tax look like for you, right? Because a lot of folks come into this process not understanding how the purchase price and how the structure associated with that purchase price results in after tax value. There are certain structures that we can push a transaction towards, that we can educate the buyer market on, that are beneficiary to a person's individual situation that we can ultimately achieve for them. But if you don't tell us what those are up front, we don't understand those, then we get all these offers in, we get these LOIs in, they look a certain way. We take them back to the folks that are helping do the personal planning. Like, oh, well, based on their situation, this would have to look like this. We get a much better tax situation. If we did this with these dollars, then we get a better outcome here. Now we have to go back and resell it to somebody who already kind of put their stick in the sand and how they want this deal to happen, right? That's a lot tougher process than if we would have known that up front and went up front with that mentality and achieved that outcome initially, right? Because now everybody's on board with that, right? So I think having that done up front is critical, right? In terms of the tax side of it. And then two, the other piece is, what do I actually need here? To retire.
Right.
Because a lot of folks don't understand that, right? Like the need and the want is a lot of times they're latched onto a number that may or may not be achievable, right? And you may not even need that, right? So you're walking away from what are good quality, solid offers for what you are selling and the value that you're ultimately transitioning because you think you can't. And it's like, no, you actually can, right? I mean, and this is more than enough, essentially. So I think just having that education up front, that mindset, that training is hugely important because, the psychology behind this is every bit as important as the math, and without having that hand holding, without having somebody to talk to, without having that buffer on the emotional side of this, this is a big deal. And I think, if you go back to the demystifying or the misconceptions that we talked about earlier, there's probably another one for you. Because a lot of people think it's a business transaction, and it is, right? But the level of emotion involved in this is unbelievable. We all like to think we're logical, rational human beings. Baloney, we're all emotional human beings, right? We are all emotional beings. You're not going to believe the level of emotion when somebody points out some problems or some things that are suboptimal for something that you've spent 40 years of your life building, right? You don't take it too kindly a lot of times, right? Even if they're right, it's easy to be insulted by some of that.
Sure.
And I always try to tell sellers, listen, don't worry about it, man. Like if they didn't think they could do it better than you, they wouldn't be here. They wouldn't be interested. You got to let them have that. Don't take it personal.
It's a really good point. I mean, I guess I have the benefit or curse of having two seats at the table on the wealth management side as well as the exit planning side. So I do see the emotion. I do see not having the plan for after the business is transferred, whether it's internal or external. If I had to choose one thing out of what you said, I think that's the biggest thing that's overlooked. I can't remember if it was McKinsey, Deloitte, one of the big four accounting firms did a study that said 50%, or directionally, I'm in the right spot here, more than half of business owners profoundly regretted selling their business a year or so after they did it. And it's not because they didn't get the price they wanted. It's not because the structure wasn't sound. It just didn't align with what they wanted to do after business ownership, or they didn't even have a plan to begin with for what post-transition looked like. So you hit the nail on the head with absolutely everything that you said. And I think that's also a really good way to take us to what I think is really important for people to note here is what are some of the factors of a transition that you think business owners focus on or don't focus on that they should more? And I'll give you an example because it's kind of an abstract question. I think everybody has a number in mind. I think everybody has a multiple in mind when they go to sell their business. I want 5x EBITDA based on my industry. I want $30 million for my business. And that's all well and good. We all care about those things. What are some factors of a structure of a transition that you think should focus on more or focus too much on?
Good question. It's a loaded question. As soon as you said 5 times EBITDA, for example, the first thing that popped in my head is 5 times what, right? Because everybody says 5 times. Well, 5 times what? 5 times trailing 12 months, 5 times a 3-year average, right? 5 times, projected year one, depending upon the business and who you have as the table's potential acquirers, that's all going to change. You can really, and then I say the other part of this too, right? And I'm just to use that example because it's a great one. Is like, okay, well, are you talking 5 times cash at close, right? Is it 5 times over the next 5 years, over the next 7 years? How much of that is contingent on future performance, right? How much of that is down payment? How much of it is seller financing? A lot of sellers start this process and they're not understanding the difference between seller financing and an earnout, for example, right? When you take all of those things, and I think that's the answer really to the question that you're asking me is, in my mind, people focus too much on just the dollars, right? The structure is every bit as important. If you go back to the tax concepts that we talked about a little while ago, you want to structure this in a way where it's about after-tax dollars that you're getting, not purchase price, right? And then, to the extent that you have future dollars that are tied to the performance of this company moving forward, well, you got to start asking the question, who is this acquirer? What's their ability to succeed? Do I believe in them running this company? Do I believe there's a fit here where they can really achieve and accomplish those things? If not, and that money is important for me to decide that this is a deal worth doing, what are you evaluating? To me, that's such a big part of this, is the structure itself. The time that you're willing to put into this, the time that you don't want to put into this. I mean, just thinking holistically about the transaction, right? Because there's a lot of pieces and parts here, and everybody just goes straight to price. It's ridiculous when you look at it this way, right? You say, okay, I'm just making this up, but I want $10 million for this business. If I get $10 million, and we'll just do it because it's a little easier, then I'm ready to exit. All right, well, what if somebody came in and said they'd give you $1 million for the next 10 years, every year for the next 10 years? Right? That's a very different deal than I'll give you $10 million today. What if somebody said, hey, I'll give you $1 million today, and then if this happens, and this happens, then I'll give you $1 million the second year. And then if this, and this happens, I'll give you $1 million the third year. Oh, by the way, as soon as those things don't happen, well, it's over. You get what you get. There's a lot more that goes into this than just the price, but that's where everybody goes right away. And I tell people all the time, listen, if you just want to focus on price, I can flip you around, turn you over, spin you around, and send you out, the side door, and you didn't even know what happened.
Sure.
It's the wrong thing to focus on. You got to look at this thing holistically, big picture.
Yeah, and I see it every day in my own industry. M&A is crazy in wealth management right now. And there's this competitive nature where, hey, that book of business down the street sold for revenue's big in my industry for a certain size. So that book of business sold for 3.5 times revenue. And you fall into this habit of taking that headline number and thinking that it means something for your business. So you're talking to a business owner and, hey, so-and-so down the street sold their manufacturing company for 8 times EBITDA, and they don't do as good a job as I do. I could probably sell mine for 10. Well, if 8 times EBITDA for them was a 15-year payout and they only got a little bit up front, is that really the best structure for you? Would you be better off with 6 times if it meant that you're getting a cash deal up front? So just repeating what you said in different terms, people don't understand that the headline number is really just a measuring stick, and you're never going to even get the true number from the person down the street. When they're at the country club, they're pumping it up.
100%, right? It's all ego, right? And so now so think about what we were talking about earlier in not understanding, the valuation equation, right? And like how to build that value. Now you're going with a misconception about what it's worth, right? If nobody manages those expectations up front, folks are willing to give you a really good offer, right? These offers might be very good, but you're evaluating them on the wrong metrics, because you don't understand what the right metrics are, right? And that's where that intermediary, that M&A advisor, the folks that do what we do, we talk about that up front, right?
Sure.
And we talk about that early on and say, hey, listen, I think, I don't know what the market's going to ultimately bear, right? Because value's in the eyes of the beholder, right? And there's buyers out there that are going to see additional value because of the business that they've built, because of the markets that they want to get into, because of the products that you've built. Like there's synergistic value there that we want to try to unlock. We can't always understand what that is when we're going to market. So we're reaching out to these buyers, hoping we can unlock and believing that we can, but we don't know what the number is going to be. So we'll look at you and say, hey, listen, I think, that the business is worth at least X. And if we can't get X, then you're not being treated fairly. Right now, we're going to push for a heck of a lot more. And we think we can build a market that will allow us to extract a lot more. But hey, this is our baseline number. I think this plus, right? Anything less than that doesn't make sense.
Sure. Now, with all the information that's floating around, we have it, the access of our fingertips, for better or worse. If you're a business owner and you aren't necessarily ready to go down the path of M&A right now, where do you suggest we look? I mean, should we be scrolling Twitter for our information? Are there blogs or podcasts that we should be reading and listening to?
Yeah, no, great. That's a great question. And my advice to everybody always is reach out to the investment banking guys, to the M&A advisors like myself, right? We're interfacing with buyers on a daily basis. A lot of the buyers, that's their full-time job. Think private equity family office. That's what they do for a living, right? Is acquire companies. We're socializing with these folks. We become like 20 years. You talked about it, right? Become friends with a lot of these guys. We drank beers with these guys for 20 years. It's very easy for me to have a conversation and say, hey, listen, so a business that is in this industry, you guys bought one, 5 years ago, right? How did you think about that when you bought it? What was important, right? What added value for you in that? What detracted from value? And folks will tell you, because again, they're your buddies, right? They're going to say, hey, listen, somebody that has these types of customers, we've seen a ton of value in them, right? If you don't have those couple kinds of customers, then no one's buying it, right? It's not as sexy. Or hey, listen, they got to have margins up above 30%. Without that, it's a commodity business. We don't want it. Whatever the issues are in that particular vertical, we'll get that feedback for you. We come back to you and say, hey, listen, here's what we're hearing. Here's what makes that business attractive. Here's what buyers want to see, and we can start thinking about that business and looking at that business and de-risking it. We talk about the value equation, it's risk versus return. Everybody focuses on the return side of the equation. Most folks aren't thinking about the risks associated with it. What a buyer wants to know is, hey, what's the likelihood that we can continue to reproduce these metrics year after year after year? And what are the risks associated with the fact that we might not, right? So a lot of times when you go back to these business owners, it's really about, hey, you've built something great. It's really working. But there's a lot of risks around that repeating itself once you're gone, right? Is the infrastructure built so that you can step out and that continues to go? Right. And that's the type of feedback that we can get a business owner, where the business itself has value, not the business under its current ownership structure, if that makes sense.
It does. And you've given us a great look behind the scenes into how people can really, business owners specifically, can extract the most value for their business. It's a process. They need to be reading early and often, and they need to be structuring the relationships with people such as yourself. I guess this isn't even a question. I'll wrap up on this. Where can we hear more from you? Where can people find you online?
Yeah, I mean, our website's reag.com. Feel free to check that out. There's a lot of great information on there. We're always happy to talk and to share too. Our numbers on there as well in terms of how to reach us. But email is smashuda@reag.com. Hit me up anytime. I'm happy to. I love this conversation. Hopefully, the passion about the industry kind of comes out when I'm talking, because I get excited about this stuff. I love what I do, and like I said before, I mean, I'm happy to help because this is folks' life's work that we're really dealing with. And anybody that grew up in a family business understands how important this is to a family or to a business, or it's built one themselves, right? And I'm one of those people. So anything we can do to help, please reach out.
Scott Mashuda, really appreciate you taking the time. I'll link everything that you just said in the show notes that people can reach out. And I know you guys published a lot of really valuable content on your website, so I do hope people check that out. Thank you so much for joining again.
Thanks, Jordan.
Price Discovery Money and Mindset is brought to you by Wernick Wealth Managers and Chagrin Valley Business Strategies. Opinions expressed by Jordan and guests are their own and do not represent investment advice, solicitation, or the like. For more information and resources referenced in this episode, be sure to check out the show notes. Thank you and see you next time.